Hello everyone, I'm Taj Singh, President and CEO of Discoverysilver, and joining me today is Forbes Gemmell, our VP Corporate Development. Forbes is also the owner's rep on the Cordero Project PEA. We're very excited today to be able to share with you a snapshot in this video of the PEA results. The full information is obviously available in the press release, which has an extensive appendix as well. And again, this is 2 years of hard work. We're very excited to be able to put this out, and we believe this clearly positions Cordero as a tier 1 silver asset. So moving on, we will be making forward-looking statements during the course of the presentation. And first slide here, I want to go over some of the key PEA highlights. First off, very strong project economics. At the base case, we assumed a silver price of $22, silver, $1,600 gold, $1 lead, and 120 zinc. So conservative prices for this base case. NPV posted of 1.2 billion US, that's 1.5 Canadian. And on a per share basis, that works out to Canadian 4.62 a share. IRR also very strong, 38%, and a payback of 2 years. If we go further and look at the kind of an upside scenario and see what kind of leverage the project has, again, that shows very strong as well. The upside case was based on a 1-year trailing 90th percentile price, so very realistic pricing. We're looking at kind of an upside scenario. After tax NPV of 1.9 billion US was the result, and Canadian 2.4 billion. That works out to 738 Canadian a share. IRR spikes to 55% and a payback of 1.4 years. And just to indicate, the silver price assumed was $27.50, gold price $18.80, lead at $1.10, and zinc at $1.45. Also, looking at the mine life, I think it really sets Cordero apart. A 16-year mine life, very hard to find in the silver space. Average annual production of 26 million ounces. Long mine life, very impressive scale. 26 million ounces, silver equivalent per year average, puts Cordero as one of the top 5 primary silver mines. And in several years, it goes through 30 million ounces silver equivalent, which makes Cordero a top 3 primary silver mine, or even higher. So obviously very impressive scale. On the other side of that, cost profile was also very attractive. Average life of mine all-in sustaining costs of less than $12.50. So really that combination of long mine life, significant production per year, and low cost, really the 1-2-3 punch that really sets Cordero apart. If we look at capital intensity, we see a very palatable initial development capex of $368 million for a project of this kind of size, very palatable. You look at the NPV to capex ratio in the base case, 3.2 times, and in the upside case, 5.1 times. So industry-leading metrics from a capital intensity point of view. Also, the project, we speak to it quite a bit. The project was very technically robust. 99.1% of the tons in the PEA mine plan were in the measured and indicated category. You don't see that very often at all in the PEA level. So that was a very impressive metric for the Cordero PEA. And the study was led by Ausenco, as well as support from Knight Piésold and AGP Mining. So a very strong team backing this study. And if we look at revenues, kind of a metal split and how much silver represents of the revenues. Silver represents over 60% of the net revenues in the first 5 years of the mine life, and over 50% of the net revenues over the life of the mine. I will now pass off the presentation to Forbes, who will be leading us through some technical details of the project.
Thanks, Taj. So we're going to start off with the mine plan. So the mine plan was broken out into 4 phases. Phase 1 is in the southwest, targeting the Pozo to Plata zone. We've got some good grade material right near surface there. There's a very small phase 2, which is chasing some good grade oxides in the south corridor. And then phase 3 and phase 4 are pushbacks to the northeast. And so the ultimate pit for the PEA, we've got about 230 million tons of ore at an excellent strip ratio of around 2:1. And what's interesting to note when you look at the plan map on the right, comparing the resource pit to the PEA pit, there's over 300 million tons of resource that sits outside the PEA pit, but still within the resource pit. So that represents excellent optionality at higher silver prices to either extend the mine life or increase production. In terms of the mine plan by year, the first shovels in the ground are in year -2. In year -1, we're now placing some of the oxide material on the heap leach. And then in year 1, we're now processing both oxides and sulfides. And what's really nice to note is the average mining rate, very steady over the life of the mine at around 60 million tons per annum. And then also the strip ratio relatively steady at around sort of 2 to 1 over the life of the mine as well. You'll notice in the columns there, in that sort of goldy color, the ore being sent to stockpile. So we've been very strategic in our use of stockpiling, placing the low-grade material on the stockpile to prioritize the high-grade material, and making sure that high-grade material gets through the mill earlier on in the mine life. And so you can see in the background, the stockpile balance gets built up over the life of the mine, and then we process the stockpiles from year 13 onwards. In terms of the process schedule, so year -2 is when we build out the crushing circuit for the oxides in the heap leach. So year -1, we're now placing oxides on the heap leach and generating some cash flow from that. And then year 1 is when we bring the sulfides online with a second crushing circuit, and then we add a ball mill and a flotation circuit. So year 1, we're now parallel processing oxides and sulfides. And then year 4, once we're through the good grade oxides, we then add a second ball mill and a second flotation circuit, and we use that second crushing circuit for the oxides, and we're now a sulfide only plant, and any additional oxide ore is effectively run and mine, so that'll be placed uncrushed onto the heap leach pad. And what's really nice to note is you look at the grade profile over the life of the mine, we're hitting our best grades early on in the mine life for both the sulfides and the oxides. So that helps bring forward cash flow and ultimately helps maximize the NPV of the project. You can see at the tail end there, the grades drop off quite a bit, especially from year 13 onwards. That's that low-grade stockpile material I referenced earlier. So what does that translate to? If you look from a production point of view, first 12 years of the mine life, the average production is north of 30 million ounces silver equivalent. So that most likely places Cordero as a top 3 primary silver mine globally. So very impressive scale. And what else is a great result for us is when you look at the AISC, over those first 12 years of the mine life, we're averaging less than $12 per ounce. So that obviously is going to generate a lot of cash at current silver prices, but also offers a lot of downside protection as well, given that those excellent margins. So Taj, touch on the Capex. The initial capital build is around 370 million. So year -2, most of the money we're spending is on the oxide circuit and the heap leach. Year -1, we're then adding the sulfide circuit to that. So 370 million, which considering the scale of production is a relatively palatable amount. And then year 3 is when we expand to go sulfides only. So we're adding the second ball mill, the second flotation circuit. And then year 8, as we come down to some higher zinc grades, we expand the back end of the flotation circuit. Life of mine sustaining Capex around 200 million. About half of that relates to tailings, the tailings dam, and then the other half just ancillary items across the project. In terms of the operating cost assumptions, so for mining, we're assuming contractor mining in the study. We receive contractor quotes, and so that average cost of around sort of $2.10 a ton. That compares reasonably when you look at recent studies and active projects in Mexico that are often sub $2 a ton. So we feel that's a very good, solid cost estimate for mining. In terms of processing, Ausenco built these cost estimates up from first principles based on our detailed metallurgical test program. And what's really nice to note when you look at the sulfides, an excellent operating cost there. We're really benefiting from being able to target a coarse grind size. So we actually get better recoveries at a coarser grind size, and what it means is we don't have to have a SAG mill. So obviously without that SAG mill, our OPEX comes down, and we get the added benefit of low power costs from being in Mexico too. The site G&A, around 90 cents a ton. So that cost assumes a small camp and administration office at site. What is lovely here is we benefit from Parral, a very key active mining town, just being down the road from the project. So we don't have to have this massive camp at site. And that's typically the type of operation where you see inflated G&A, and we don't have that here. Hence we're sort of at that 90 cents per ton mark for site G&A. So in terms of the outputs from all those inputs, there's probably three key sets of numbers I want to point towards. One is the base case result for us, which used a $22 silver price, zinc at $1.20. You can see the NPV there. Very impressive at 1.2 billion, IRR almost 40%. When you stress test the model and you move to the top left of this box, silver's at 18, zinc's at $1.05. You can still see the NPV is north of 700 million, and the IRR is still close to 30%. So there's good downside protection there. And then when you look at the upside scenario, so down to the bottom right of the table, where silver at $30 per ounce, which obviously we've been close to touching that a few times in the last 18 months or so. And then zinc at $1.05, $1.45. Zinc is actually trading above that right now. You can see the NPV is now at 2 billion and the IRR is now at 60%. So obviously that highlights the exceptional leverage this project has to higher commodity prices. I'll just hand it back now to Taj just to finish off with a couple of comparisons to our peers.
Thank you, Forbes. This chart here plots silver equivalent production and market cap of various major and mid-tier silver companies. The estimates are from BMO Capital Markets for 2022. You'll see here that Cordero is also put onto this chart, and you'll see it screens very well in terms of size and scale versus the other producers, and it actually fares extremely well to the top end of the production levels here of Coeur, Hecla, and First Majestic. The interesting thing to note is Cordero is really just one asset, and that basically comes in line with the production levels of Coeur, Hecla, First Majestic, all of their mines combined. So it's a very interesting to see. Really, really illustrates the scale of Cordero. Screening very well in terms of size, in terms of average annual production. Now, looking at the black dots, you'll see those are the market caps of the various companies. So it kind of gives you a feel for, these companies that are kind of producing at those kind of levels. Sometimes north of 3 billion US market cap, and you see Cordero, Discovery trading at about 500 million market cap or so. So clearly a valuation gap. Obviously they are producers and we're developers, but it shows, the potential to close that valuation gap as we advance the project. Obviously you can have impressive scale, but how do the costs line up? And you'll see here the same universe of silver companies. Again, the estimates are from BMO for 2022. You'll see Cordero also put on the same chart, fares extremely well in terms of all-in sustaining costs on a co-product basis, among the lowest on this in this period comparison. So not only do we have the impressive size and scale, as I noted, but very impressive and attractive cash cost profile, all-in sustaining cost profile. So just to close, thank you very much for joining us here. I'd like to really hammer home and reiterate, if it wasn't clear, Cordero is a very simple project in terms of location, logistics, permitting, metallurgy. So we'll continue to advance it. We think this PEA puts us in a great position to add value over the next 12 months and beyond. We're very encouraged by the results here today. Thank you very much.